Today I'm here with Bill Willoughby from NorthPointe Bank. He has 20 years experience and he's going to go through all the ins and outs of the mortgage industry and all the questions that you have with us today. So we're going to get started. Bill, thank you so much for being with our group today. How are you?
I'm great. Thanks for having me on, Miss Connie. I appreciate it. Doing
Yes.
well. How about you?
I'm doing wonderful.
We often hear the terms pre-qualified and pre-approval. And so, Bill, I was wondering if you could explain to everyone today the difference between pre-qualified and pre-approved and what that means when they're going to buy the home.
Absolutely. So pre-qualified is the most typical thing that we'll see. A lot of times when agents ask for a pre-approval letter, 90% of the time what they're getting is a pre-qualification letter. So what that pre-qualification letter means, basically we've taken an application, or the loan officer has taken an application from that borrower, but it has not been reviewed. So the application hasn't been reviewed. A lot of times income documents or asset documents haven't really been reviewed by an underwriter who ultimately makes the loan decision. So pre-qualified is not nearly as strong of a letter as a pre-approval. So at NorthPointe, we actually have what we call a true approval process, where we gather all the documents. We can do a traditional pre-qualification, which is usually much quicker, easier, but we can take the extra steps and do a true approval so that when we issue that letter to the agent and to our borrower, you're making offers. They know that not only has your information been taken by the loan officer, but it's been reviewed by the person making the decision on the loan. So it's a much, much stronger offer, and that letter holds a lot of weight in getting your accepted offer.
Awesome. Thank you so much. So with the market shift and the increased interest rates, we hear a lot of, especially first-time home buyers. They say they're going to wait and not get a house right now because the interest rates. What would you say to that first-time home buyer to get them in a house and stop paying rent?
There's no better time than today. And I know that sounds cliche, but if we look back, it'd have been great if we bought a house a year ago or 2 years ago when interest rates were down in the twos. But unfortunately, we're not seeing that, and we're not going to see that for any time soon. But what we are pretty confident in is that home values are going to continue to increase over the next few years. So buying now at a higher interest rate than what they've been historically isn't necessarily someone's initial goal. But if you look at just the numbers, it's much better to buy than it is to rent. And you've got the option to lock in on your house now at the values currently, as opposed to waiting for that appreciation. If you wait till the summertime and in different time frames or different areas where we are anticipating rates to drop, it's going to be a lot more competition. Competition drives prices. So you're going to end up paying more for that home. So we're recommending buy the house now. If it's truly the house that you want, buy it at the lower price. Yes, it's going to be a cheaper interest rate. Most likely you'll be able to refinance some point in time within the next couple of years, likely. So definitely a better time to buy now than to keep throwing away your money at renting from someone else.
Wonderful. Thank you. So with the difference in the shifts in the market, we have also seen that often sellers will want to incentivize purchase. And so they will, at that point, offer a 3-2-1 buy down for the buyers. Can you explain to us what a 3-2-1 buy down is and the pros and cons for a buyer?
Absolutely. So a 3-2-1 buy down, there's several variations. A 2-1 buy down or a 3-2-1 buy down. We use a 3-2-1 buy down for this example. Basically what that means is your interest rate is going to change 3 times within the initial first 3 years. So the first year, we use current interest rates have been hovering around 6.5 to 7. So let's use 7% just kind of as a guide. The first year, so your first 12 months is going to be 3% lower than that. So that's where the 3 and the 3-2-1. So your first year, your interest rate's going to be, your payments are going to be based on 4%. Your second year, the rate's going to be based on 5%. The third year, it's going to be based on 6%. And then after the third year, it goes to the 7%, which is your initial. The primary benefits for that is obviously you have a stair step into the higher payments. Most likely, again, we're anticipating rates are going to drop, so you'll have the benefit and still be allowed to refinance down the road within, before likely the 3-2-1 fully matures and then you pay the full note rate. So it allows you to stair step into that payment and gradually go from, if you have someone, again, that's a second time home buyer, they're moving up from, let's say, a $200,000 home that they locked in on 2 or 3 years ago. Now they're buying a $400,000, $500,000 home at a much higher interest rate. They don't have such a big payment shock, and it lets them gradually get into the newer payment. So great thing for buyers right now. We are seeing a lot of chatter about that and a lot of people that are interested in it. The other benefit of it is that money is put into an account. It's actually a deposit. So that money typically is paid for from the seller, which is the cost for the 3-2-1 buy down. That money is deposited into a separate escrow account for the buyer. And when they go to refinance, any money that's left over that hasn't been used from that temporary interest rate buy down is available for them that will come off of their payoff. So they're getting an added incentive and benefit if and when they do refinance, within that first 3-year period.
Okay, thank you. When a borrower first calls you,
Yes, ma'am.
oftentimes they don't even know what to expect. So can you walk us through exactly what happens from that initial phone call and the communication forward?
Absolutely. So initially, the phone call is a lot of the first interaction that we'll have with someone. I love to do it on the phone and introduce myself to them, get to know the client a little bit, and try to walk them through what exactly the expectations are. From there, we'll take an application. Typically, that's going to be over the phone, and we'll actually take the application ourselves. We do have, obviously, 2023, we've got the option to do an online application, but I prefer to take the application over the phone with the client so I can go through, ask them the questions, and then I will send them a follow-up, either a text or an email, and let them know what documents that we're going to need. We're going to be verifying your income, your assets, those kind of things. So we'll get bank statements, W-2s, pay stubs. Depending on their situation, we'll send them a list of exactly what we'll need from them, and then we'll set up a time or a time frame to call them back. Typically, it's something we can review, at least the initial, as we talked earlier, the difference in the pre-qualifications and the pre-approval. Typically, we can get somebody pre-qualified within the same day if they'll get us all the information, and we can, review some of those income documents. We'll get back to them and talk to them about what is their goals, what is their budget, how much money do they have to put down. And we'll look at, in NorthPointe Bank, we've got tons and tons, well over 300 loan products. So we'll try and figure out which one of those loan products fit each borrower in their situation, and then go over their budget with them. If you want to spend $1,600 a month and you've got $20,000 to put down, then roughly here's the ballpark of what you need to be within for your purchase price in order to obtain that target goal for them.
Oh, wonderful. That was leading to my next question. How does someone know exactly what they can afford in a home?
So everybody's different. A lot of people don't know. And so that's one of our initial questions, and what we always like to ask and find out from people is, hey, what are you comfortable with? Because a lot of times I can approve you for a number, in most cases, that's higher than what you want. On the flip side of it, there's sometimes that people are comfortable with a much higher payment than what the underwriting and our underwriting systems will approve. So I start with the first question, ask them what their budget is. I'll present those options to them to let them know here is the purchase price range that you need to stay within in order to stay within that budget. But then I'll also let them know, you've got plenty of room. It looks like, you could go up another $20,000, $30,000 in purchase price and we'd still be able to get you qualified. Again, my number one thing is wanting to make sure that they're comfortable with that payment. But sometimes people just don't know. On the flip side of it, I'll unfortunately have to have those conversations and say, hey, you're one to spend $2,000 a month, but based on the income that you have coming in and your other liabilities, we really can only get you qualified for up to $1,600 a month. And so we give them both what they are approved for, but then also kind of give them a gauge to let them know how tight those numbers are if we have some flexibility.
So if a buyer comes to you and they want to buy a $400,000 house and you approve them for $450,000, would you recommend that they try to keep it down lower, or do you feel pretty confident that if you qualify them for $450,000, you feel pretty confident they can go with that?
Absolutely. Right now I leave that up to the customers. Obviously, they're the ones that are going to have to write the check or have that automatic payment coming out of their bank account each month. But what we're really big on is, again, making sure that they are comfortable with it. If I give them the thumbs up, the pre-qualification initially up front, that it's good, I'm very confident that we'll be able to adhere to that. On the flip side, we are seeing mortgage rates that are very volatile right now, so we're trying to stay in touch with those customers every week or two to let them know as market moves, because unfortunately that could change their budget. So if they're really, really, really stretched thin on what they want to spend, then a lot more time and updating those people much more frequently to make sure that they're still shopping within their budget.
Okay. If someone comes to you and they're ready to actively start looking for a home, and you get them pre-approved, and they decide to lock in a rate, how long is that lock good for, and can it be extended?
So for most of the time, people aren't locking in on interest rates up front until they find a property. So that's the more typical. There are some products that we actually offer a service that does that, that has a minimal fee up front to lock in, because that's essentially like an insurance policy for both us as the borrower and the banks, that we're locking in on an agreed upon price. But most of the time, we don't lock in until we actually get them under contract. And then we'll present them the different options, rather based on what terms are written up in that contract. Does the contract say 30 to 45 days? Then we need to make sure that our interest rate lock is not going to expire past that 30 to 45 day time frame. There are additional ways we can extend it, but typically that's going to be something that does cost a little bit of an additional fee per day that we extend that, because again, it's a contract, we're locking in that rate. And in this very volatile market, we're seeing rates most of the time have gone up as opposed to go down. So once we lock it in, we try to make sure that we're going to hit that time frame for closing.
Awesome. Okay. And what would be your advice to someone who would not have a perfect credit score, but they want to buy a home?
A lot of people have that misconception they have to have a perfect credit score, and honestly, there is no perfect credit score. That's kind of one of the first misconceptions. But good credit typically has kind of been anything above 700. There's different guides, different loan products. We actually have some loan products where we can go all the way down to a 600. So again, it's much better to buy than it is to rent. But depends on where their credit is. We actually will help advise them and look at their credit. Maybe have some opportunities for them to do some small things. Maybe they've got some collections. Maybe they've got some credit cards that they can pay off or pay down. We'll walk them through that process to put them in the best situation so that, yes, they don't have to have great or excellent credit. They don't have to have a 20% down payment. There's different loan options for different people in different stages in their lives and their career. And it's one of the fortunate things we've got so many opportunities for them without having an 800 credit score and 20% to put down.
Okay. Well, Bill, I can't thank you enough for your time today. You've answered so many questions for our viewers, and we really appreciate it. Again, remember, this is Bill Willoughby with NorthPointe Bank, and he has more than 20 years experience. And if you have any questions and you're ready to buy a home, give Bill a call today, and he will walk you through the process.